What if I told you that a single housing bubble helped crash the entire global economy? Between 2007 and 2010, the American subprime mortgage crisis triggered one of the worst financial disasters in modern history, wiping out trillions of dollars, destroying millions of jobs, and shaking trust in the financial system worldwide. Today on Arc Digital, we're breaking down what really happened in simple terms and why it still matters. The housing bubble, where it all began. In the early 2000s, home prices in the United States skyrocketed. Banks made it incredibly easy to borrow money. Even people with weak credit, known as subprime borrowers, could get mortgages. The belief was simple: home prices always go up. So lenders offered risky loans with low introductory payments. Buyers assumed they could refinance later. Investors jumped in to flip homes for profit. But here's the problem: the entire system was built on rising prices, and bubbles don't rise forever. The financial products that fueled the fire. Banks didn't just hold these mortgages. They bundled them into complex financial products called mortgage-backed securities and collateralized debt obligations. These were sold to investors around the world, often with high ratings from credit agencies, even though many were backed by risky subprime loans. When home prices started falling in 2006, borrowers couldn't refinance. Adjust to borrowed mortgages reset to higher payments. Defaults Suddenly, those safe investments weren't safe at all. With the collapse of major institutions, in 2008, the crisis reached a breaking point. Investment banks like Lehman Brothers collapsed in September 2008, triggering panic across global markets. Credit froze. Businesses couldn't borrow. Consumers stopped spending. The US government stepped in with emergency programs. The Troubled Asset Relief Program (TARP), the American Recovery and Reinvestment Act era. The Federal Reserve slashed interest rates to near zero and introduced emergency lending programs to stabilize the system. Without intervention, the financial system might have completely collapsed. The damage was historic. The numbers were staggering. Nearly 9 million US jobs were lost. Housing prices fell about 30%. The stock market dropped roughly 50%. Household wealth fell by nearly $13 trillion. Recovery took years. Employment didn't fully recover until 2014. And the shockwaves weren't limited to America. Europe experienced banking collapses and sovereign debt crises, especially in countries like Greece and Spain. This wasn't just a housing problem, it was a global financial meltdown. What caused it? There wasn't just one cause. Experts point to risky subprime lending, weak financial regulation, over-leveraged banks and hedge funds, the rise of the shadow banking system, excessive household debt, blind faith in ever-rising home prices. In 2010, the US passed the Dodd-Frank Wall Street Reform and Consumer Protection Act to strengthen oversight and reduce systemic risk. But debates continue. Was it government policy, Wall Street greed, regulatory failure, or all of the above? Long-term consequences. The crisis reshaped politics and economics worldwide. It fueled distrust in financial institutions. It sparked movements like Occupy Wall Street. It intensified political polarization. And it changed how central banks respond to economic shocks, something we saw again during later global crises. Even today, the lessons of 2008 influence how markets are regulated and how risk is managed. Why this matters today. Financial bubbles don't announce themselves. They build quietly. They feel normal. They look profitable until they aren't. Understanding the subprime mortgage crisis helps us recognize warning signs before history repeats itself. Call to action. If this breakdown helped you understand the 2008 crisis more clearly, hit like, subscribe, and turn on notifications. This is Arc Digital, where we simplify complex economics and expose the forces shaping our world. See you in the next video.